Dear clients, welcome to Phillip Securities Research Weekly Market Update. Global equities have held on to this rally on policy anticipation, but our conviction of this rally continuing beyond the 10% or so it has afforded us so far is low from a fundamental point of view. The global economy is still slowing, with uncertainty concerning the US fiscal cliff making things worse. In the meantime, concerns about Spain resurface as regional governments seek cash handouts from the central government. Essentially, Eurozone debt compounds faster than nominal GDP, so risks about bond market panic will linger unless a growth solution is found. The intermarket short-term picture changed somewhat on Friday to risk off. The dollar surged, 10-year treasuries rose, while the S&P 500 commodities and crude fell. We think it's time for some caution if you're on the long side or to consider building shorts. For one, we have had already a decent rally on policy anticipation. Secondly, the direction the global economy is actually moving is beyond the help of further QE. While China is not in a hurry to re-accelerate the economy beyond what is required to meet the 7.5% target. As we think absolute returns for stocks everywhere over the next 6 months could prove difficult, we favor ASEAN markets, the KLCI, JCI, SE, TI, PSEI, and the STI, to be relatively more resilient. For the first four, valuations are not cheap, but growing domestic demand, government policy, infrastructure requirements will counteract somewhat a weak external environment. As for the STI, it somewhat joins the ranks of an ASEAN market for us, as we estimated about 60% of earnings comes from ASEAN and emerging markets. In addition, Singapore also shows a dividend yield of about a full percentage point more than the Asian average, which thus makes it an attractive buy in these yield-starved times. The Sing dollar's relative safe haven status also makes that an even more attractive prospect. Overall though, we favor fixed income over stocks, given our global slowdown, receding inflation outlook. A repressed rate environment is inducing a global search for yield beyond the traditional safe havens of treasuries, bonds, gilts, and Singapore government securities. Thus, in the ETF bond space, we favor dollar-denominated emerging market sovereigns, ticker EMB on the NYSE, Asian sovereigns and corporates, ticker N6M and O9P on the SGX, and US corporate debt, ticker VCLT on the NYSE. Dividend stocks are also likely to be a spillover beneficiary. Our Singapore sector Strategist is still overweight the high-yielding defensives, aviation services, SIA Engineering Company, and SATS, and the REITs. Clients can access our regional stock recommendations from our regional strategy reports on POEMs. Thank you for watching, and tune in next week to Phillip Securities Research Weekly Market Watch.